So within fintech, actually, a lot of our friends would know about Property Guru Finance. Now, as TK mentioned, we are in the space of property marketplace. When people want to find their properties, they come to propertyguru.com.sg to look for the properties. And some time ago, we decided that just helping people seek the properties is not good enough. We help them find their properties and finance their property. So that's why Property Guru Finance was born out of that, to help people find, finance, and own their properties. So essentially, we launched our business about a year ago, and we've served more than 1,500 clients actually within the year. So yeah, it performed very well. It meets our objectives to help people.
That's awesome, Paul. Just some housekeeping rules as we begin our Ask Guru webinar. This is for the audience out there. You can start posting questions in the chat box or your comments on Facebook. And if there are any unanswered questions because of time, please drop them in the Ask Guru forum. You will be shown the link later at the end of the webinar. So let me begin, Paul, by sharing how the residential property market has been faring with the release of our Property Market Index report, the second quarter 2021, and also URA's first quarter 2021 real estate statistics. From the second half of 2020, we saw a vibrant residential property market that went beyond what was initially described as pent-up demand. New home sales closed the year just a tad below 10,000 units at 9,982, and secondary market sales soared 20% year on year to 10,729 in 2020 as compared to 8,949 in 2019. HDB sales also spiked 4.4% to 24,748 as compared to 2019. And this was an 8-year high. Prices in private residential market rose 2.5%, while HDB rose 5%. Now, Paul, in the first quarter of this year, prices of private residential properties across Singapore increased quarter on quarter by 3.3%, steeper than the 2.1% growth in the fourth quarter of 2020. And for the non-landed segment specifically, the increase was 2.5%. Now, the first quarter of the year closed with a 3.84% or a 4.3-point quarter-on-quarter increase in our property market index, and that brought it up to 117.8 points. Now, not only is this the fourth consecutive quarter of price growth in the non-landed private residential property sector, but it is also the most significant increase we've recorded since the second quarter 2018. We also saw a 14% or a 19-point decline in our property supply index to 116.1 on the supply side of things. Although not as steep as the past few quarters, there has been a consistent downward trend since the third quarter 2020 as buyers continue to snap up properties. And some of the new developments such as Normanton Park, the Reef at King's Dock, and Midtown Modern saw superb sale results in their first day of launch. And developers sold some 3,493 private residential units, excluding executive condominium units in the first quarter 2020.
Wow.
And that is about a third more than the 2,603 moved in the final quarter last year. Let me just share a bit about the resale volume as well, Paul.
Yeah.
The resale volumes of private residential properties ticked up by 6.4% in the latest quarter to 4,519 transactions, compared with 4,249 units in the fourth quarter of 2020. And secondary market transactions accounted for 48% of the private housing transactions during the quarter. And this increase was driven by prices in the rest of Central region as compared to the last quarter of 2020. And that's a 6.1% over 4.4% in the final quarter of 2020. And in contrast, prices in the core central region fell 0.3% compared to a 3.2% increase in the previous quarter. And then prices in the outside central region edged up 0.9% compared to a 1.8% increase last quarter. And what's remarkable is that prices of landed homes rose by 5.6%, reversing a 1.6% decrease in the previous quarter, while that of non-landed homes actually rose by 2.1%, slowing slightly from 3% last quarter.
It's amazing how much data you have in the head of yours, TK.
Well, yeah, we have been observing the market for a long time. In fact, like I mentioned earlier, since 4 quarters ago. And so we've been keeping with the market pace along. So these numbers somehow, it's a quick remembrance.
But based on those numbers, that's why there's this talk about everyone's looking at the cooling measures and expecting them to come up. So maybe you want to share and talk about it.
Yeah, actually, numerous property curbs have already been put in place in previous years with the goal of discouraging speculation and ensuring that buyers do not overextend themselves. It is likely that if the government were to implement any new cooling measures, it will include a tightening of existing curbs. And just to give us a run-through of some of the existing regulations with respect to property curbs that were put in place over the years, you have the total debt servicing ratio, that's TDSR, and the mortgage servicing ratio. So the TDSR and the MSR were introduced to deter buyers from taking on excessive levels of debt. And then you have the loan to value limits, which requires financial institutions to restrict their home loans to a certain percentage of the value of the property. And that's really your forte, isn't it?
Well, I don't know whether that's my forte, but I certainly know a bit more about this segment. Yeah.
All right. And of course, the ABSV. That was introduced since 2011. There was also a further tightening in 2018, right? Yeah, so if we are talking about what are some of the possible cooling measures that we can expect in 2021, I think in terms of the specific policies, I would think that LTV and MSR could be further tightened due to the current ease of access to affordable credit in a low interest rate environment. If stabilizing the market is what the government is aiming for, then the tightening of the borrowing limit will definitely be one of the considerations. Paul, what do you think?
Well, I think that the cooling measures in the previous times happened in the time where the economy was doing very, very strongly. But right now we're getting a bit of a mixed signal. I've been mulling over this, and I think we've had numerous discussions about where we expect cooling measures and so on and so forth. So one of the things that we are seeing is that the fact is we are in the middle of a pandemic. I mean, we're now in phase 2B, right? People are concerned that, gyms are closed and so on and so forth, people are concerned that this will affect business and all that. So I think it is a bit of a challenge, right? The government needs to look at this and say, if we implement cooling measures, will it overshoot the desired effect? What are the potential impacts on the economy? Remember, property contributes a lot to our economy. And if they were to put a dampener and say cooling measure, it could overcool and freeze the economy. So I think these are the challenges. Now, if we look back at history, like I said, it is all during that period of time. The other thing is this, the government always thinks about protecting first-time buyers, right? So even during that time in 2018, when they tightened the loan to values where they drop 80% to 75%, meaning you can borrow 75% on the purchase price rather than 80%. I think the compensating factor was that you can still borrow up to 90% for a HDB loan. That didn't change, and that supports a lot of first-time buyers when you go to the HDB to borrow funds for your purchase. So essentially, the thinking is always in that direction. I think it's really important. You mentioned the TDSR, the MSR tightening, or the controls within the total debt servicing ratio and mortgage servicing ratio. Just to recap, total debt servicing ratio is currently capped at 60%. Mortgage servicing ratio is at 30%. Now, remember that these are based on higher interest rates. Already the bar is set rather high. So I'm not sure how the changes could come in the end, if any. Certainly, that's why we see a delay in action.
Yeah, Paul, you are right. The TDSR that was implemented in the middle of 2013 certainly addressed the issue of households overextending themselves in borrowing. And I think the yardstick that is used to assess potential borrowers is the interest rate of 3.5%.
That's right, yeah.
Yeah, so regardless of the current low interest rates environment, such as 1.3 to 1.5%, actually the TDSR would have qualified buyers who are able to borrow, and these would be able to service their mortgage loans in the long term.
Yeah.
Yeah, and that is already a layer of prudence with the existing measure.
Yeah.
I'm also looking at the fact that while the property market has been seen to be healthy and vibrant of late, it is also important to look at the reasons behind it before we even talk about the prospect of cooling measures.
Yeah.
So that's why I think the government has stated at the outset that they are monitoring the market, they are observing, right? And certainly they are not jumping into it straight away to further regulate. So if I look at the current market vibrancy, it is not primarily caused by easy access to affordable credit, because we have the TDSR, right? It still prevails, and property buyers are aware that interest rates don't last forever, or rather, low interest rates don't last forever. Instead, what is causing this uptick in property purchase is the fact that many HDB flats have reached their minimum occupation period last year and this year. So last year, there were 25,000 HDB flats.
Wow,
this year, it's going to be another 25,000. And this is the result of the fact that BTO supply from 2011 to 2014 was correspondingly increased. And so now we have this MOP effect, if I may use those words, right? Now, the expiry of the minimum occupation period means that the HDB flat owner is now free to sell his or her flat or rent out the entire flat, and is typically seen as a good time to upgrade one's home. And so, so there is an ecosystem, if I may put it, created to self-feed the market, starting from an unprecedented number of HDB MOPs to upgrading within the HDB resale market, particularly because of the pandemic. Working from home has become a new normal. And therefore, you see the upgrade trend towards 4 and 5 room HDB flats. In fact, 60% of the HDB resale transactions are in that 4 and 5 room category.
Wow.
Yeah.
Was there a big change from the past? I mean, the behavior?
Yes, because I think this is catapulted and influenced by the fact that when you are working from home, there will be various demand for space. And in fact, we saw this during circuit breaker last April, when everybody's at home, including the children. There is really competition for space. And this upgrade trend, I think, is understandable. Yeah, and we also see a group of HDB upgraders in the private residential market. And that's why developers' new launches are doing pretty well, because some of them, after selling their HDB flat as a result of MOP, they have some very decent proceeds, and they've decided to upgrade in the private residential sector.
Okay.
Yeah.
Interesting. I mean, it used to be where a lot of the clients, the 1-2 bidders or the smaller units would fly off the shelf first. I think that's slightly different now.
That's right. That's right. I think the smaller units will still appeal to those who are starting out, and their budget just they want to buy within their means, right? But the bigger units are the preferred ones, as one is able to upgrade.
Yeah.
But the fact that this is happening, it also means that it will not be forever. I mean, we don't always get this MOP effect, right?
Yeah.
So after 2021, the number of MOPs will certainly dip in line with the government supply of flats in the preceding years. So when that happens, demand for residential property is expected to fall as well.
Okay.
Yeah. And I thought, this webinar, we have this topic, right? Rising prices, right?
Yeah.
So we've been talking about cooling measures ahead of rising prices.
Yeah.
But it is right, rising prices will in some way influence the government's thinking about whether we should have cooling measures, right?
Right.
Yeah. So this rising prices thing, I feel we should look at it from the perspective that the bigger units are being bought these days, right? And therefore, the bigger units will actually cost more, isn't it?
Yeah. That's right.
Yeah. And then the URA statistic includes landed properties. And landed has been driving 5.6% increase in prices quarter on quarter, right?
Yeah, that's really robust. I mean,
that's right.
I've personally never seen such aggressive increases.
Yes. And if you take that in perspective, you can see that the rising prices is also because of this phenomenon, rather than the fact that the market is overheating.
Yeah. So maybe it's a good time to talk about what our consumers say. I mean, we did this consumer sentiment study, and we do this regularly in our studies. We actually survey more than 1,000 people. Is it 1,000? It is.
Yeah.
And basically, this was the result from our last consumer sentiment study in the first half of 2021. Maybe you want to talk about affordability and things like that, because ultimately we talk about cooling measures and people are concerned about affordability. Can one afford to buy property and so on and so forth? I think people are expecting that it becomes less affordable in line with the rising prices. They say that, in fact, it dipped by about 5 points. Right? They say, oh, well, I'm afraid I cannot afford to buy a property. Our 56% went up to 73% in terms of expectation of future price increase in the property. They say, well, I can buy less house, in the property. Now, in that respect, people look at the home loans by itself and they say, when I do the home loans, a lot of people, half the number of people surveyed don't know about paperwork. They say, well, it's so complicated. Right? So they need a lot of guidance through this process.
Yeah, that's true. I still recall this was probably 2 decades ago already with, I wasn't your colleague at that time, If I were, then I would have sought your help because I had a great challenge filling up all those forms. Yeah, and they are not easy and you require a host of documentation as well to be submitted. So I've always thought that if this could be, this pain point could be taken away from me as a property seeker and borrower, that will help.
Yeah.
And I think this is where, in a sense, PG Finance is here to help us, right?
That's right. So we are actually working on long-term solutions to this problem, but in the short term, we're helping you with the paperwork and guiding you through the process. I think that's where we come in terms of this space, and that's what the kind of feedback that we've been getting from clients. I think also tied up to this point is people are concerned that given the current economic situation, that 39% are concerned they can't raise enough money for a down payment. That's almost 40%. 4 in 10 people are concerned about that. And 36% are concerned about the income stability. People who are in a gig economy, people who are freelancers, people who are even in a service industry, right? So in this time and space, people are looking at say, what happens if we go into another circuit breaker or what, touch wood, right? People are concerned about things like that. So all these sentiments came out in our survey, in our study. Yeah.
Yeah, I think partly the sentiment could have been accentuated by the fact that in the past 1 year, the government's 100 billion pandemic aid was the cornerstone that propped up the economy.
Yeah.
Yeah, I think we have read various media reports that Singapore was actually going through the worst of economic recessions in 55 years.
Right.
And the fact that we were able to sail through, all right, last year, of course, we're not out of the woods yet, you rightly pointed out.
Yeah.
But the fact that we kind of was able to go through 2020, right, quite unscathed because of the government's pandemic aid. And we know that a good part of that aid actually lapsed in the first quarter of this year.
That's right.
And very targeted aid is now rolled out for selected industries.
That's right.
Yeah. So the economic reality would definitely start to bite in the second half of 2021. And I think the market will self-correct. Yeah. So in a sense, I'm also wondering whether there will be cooling measures, because the market self-correcting is probably something that we can leave to the forces. Yeah.
Yeah, I think that's a big point. A lot of people didn't see the impact. Why? Because remember there was a job support scheme. It really boosted a lot of companies through this difficult period. I've had the opportunity to talk to a lot of business owners, and they were saying that those kind of support schemes, even homeowners, right, who say that I have a home loan that I chose not to pay during that period of time, it really helped me. So this confidence came in very, very strongly, and really reflects in the resilience in the property market. I think that is what comes through very clearly. Now, another factor I want to talk about is actually home loans. Yeah, you talked about low interest rates, and a lot of people look at interest rates like there is not going to be a change and things like that. As you rightly pointed out, interest rates cannot be low forever. It moves around with the cycles. Now, maybe one aspect I want to talk about is, and this is basically an elephant in the room, right? It's the SIBOR. Currently, a lot of us are looking at interbank offered rates, meaning these are rates where banks lend to each other. But these are not real rates. Why do I say not real? These are forecasted rates. In other words, they tell you if I'm a bank, and if I need to borrow money, what kind of rates can I expect to incur? So that's how they determine. So let's say there are 10 banks here, right? They will rank the 10 banks. Actually, it's about 20. They will rank the 20 banks. They'll drop off the top 25%. They drop off the bottom 25%, and then they put it together and then average up. That's how you get the SIBOR rate. So in other words, if the economic data from the region, from the US comes in super strong, right? Right? People all of a sudden, the banks, you will notice SIBOR will shoot up. Right? Why? Because expectations of costs will go up. Okay, so this is SIBOR, but all this will change. MAS has already come out. They had a working group that says we are going to be phasing out SIBOR by 2024 at the latest. Now, banks have already started withdrawing such packages. Okay, that's the first thing. Second, so that is forward-looking.
Yeah.
Now, if you see this
Sora,
yeah. I don't know why I think of a soft drink called Sora. we look at,
You must be thirsty.
I'm a bit thirsty, yeah. So Singapore overnight rate average is different. So why is it different? Basically, it's a collection of interest rates of transactions that have been done by the banks in the last 24 hours. Okay, so what do they do? Basically, they will actually record. Let's say I'm a bank and I lend money, right? That transaction, the rate will be collected, the volume will be collected, and then MAS will collate that data over the last 24 hours, and then they will find the average rate. Okay, now, one of the things in SIBOR, just now notice I told you it dropped the top 25% of the rates and dropped the bottom 25%. Now, if I were a market leader, right?
Right.
Under the SIBOR regime, I'll be on top. Let's say if I lend higher, but I'm the top 25% or bottom 25%, my rates won't be counted, right? Whereas this one will be captured. And if I'm the market leader, let's say I account for 50% of the market, that will be captured, right? So if you look at that, you realize that this one actually is a closer reflection of reality because it's based on transactions that already happened. Second thing is that, so if the US market does very well, it may impact the rates for only the longer term. It doesn't impact it straight away because your expectations don't change. When you negotiate the rate with the lenders and the borrowers in between, the rates will reflect reality. I think, that's how it goes. So notice that we are changing regime. The loan packages will move from SIBOR to SORA or other base rates because SIBOR will not exist. A lot of the lenders, a lot of borrowers out in the market will be asked to choose another package by 2024 at the latest. Why? Because after that, SIBOR won't exist.
So does this particular transition from SIBOR to SORA actually help property seekers who have a home loan beyond 2024?
Well, it does introduce a lot of uncertainty, if you ask me. Why? Because you don't know what kind of pricing the banks will come up with at that time of change. That's why we find a lot of clients now switching to fixed rates to tide out the next 3 years, right? To say that, okay, I'm not sure if I'm being asked to reprice or you want to change the uncertainty of rates, like what am I going to do? Right. So that is part of the strategy. Of course, it depends on the individual needs and respective risk appetites of the borrowers. But certainly this will impact the change. I mean, that's something that will impact going forward. So let's move to the next one. This one I have to talk about it. Why US Treasury yield curves is part of the factors. If you follow the market, you realize that is a discussion in the market, the market lately. You'll say, wow, US Treasury yields are going up, it's so expensive. And when curves in the longer end are meaning towards like year 3, year 4, the rates start going up. What you are saying is that the economy will be inflationary, the interest rates will go up. So people are worried about that. Now, you notice that the FOMC, the Federal Reserve in the US, recently looked at this and they said, we're not going to do anything. We maintain to keeping the rates low till 2023, right? They have said that. So that position hasn't changed. Why? Because remember, a lot of factors have to come into play. So firstly, they say, the country is in full employment, right? But you have to look at definitions of employment. It means people who are searching for jobs, who get jobs will be considered as part of employment. But if you're not looking for a job, you're dropped from the statistic. So in a recent trend, a lot of people actually became self-employed or do gig economy, but actually overall, it may not be really full economy. So these are the questions that now it's different from other times. People are looking at this and say, really, really, do you think interest rates will be better served by being higher? I think the economies cannot take it. Right. Yeah, especially the US, where you look at everything is tied up to the Federal Reserve rates. Loans are tied up to that. If it goes up, the economy may find it challenging, right? Or individuals may find it challenging to service home loans and stuff like that. So certainly, right now, status quo, they're not doing anything. Will it affect? We don't know. I think we just have to continue looking at it. Yeah. So we have now come to the end of the. We thought it would be good to just give you a brief summary of what we've been thinking about and talking about here, TK and myself. But this is a good time now to put in your questions and ask questions. I think we have some questions already, and feel free to ask anything. Yeah. As they say, don't be shy. Okay. So, so William asked this question. Why is property price rising? Inflation fears, lack of new launches, low borrowing costs, or fear of rising mortgage rate? Property price.
Yeah, I think property price has risen because of demand, right? We can see that in the last 4 quarters, all right? And supply has been dropping, which means that the take-up rate has been healthy. So we started the beginning of 2020 with some 32,000 unsold stock. I'm talking about residential property market, right?
Right.
Yeah, and that has come down to 24,000 by the end of last year.
Right.
And in the first quarter of this year, I just mentioned that another 4,000 units were sold by the developers. So that is the reason why price has gone up in tandem with demand. Yeah, it's market forces. And at the end of the day, you find that this is also the period of time where you see in the HDB resale market, $1 million HDB flats, for example.
Right.
Usually at MOP, these are 5-year flats. And I think there could be another reason behind these $1 million flats, besides the fact that they tend to be the larger flats, right? But at the same time, it's also because we are experiencing BTO delays due to the pandemic. So completion has been kind of stretched. And those who are in need of accommodation will therefore look to the secondary market as a first goal.
Right.
Yeah. So that would be my way of answering William's question, because this is it's in response to demand. Yeah.
Okay. So maybe the next question by Christopher, you talk about Fed Reserve is likely to increase prime rate starting early 2022 to stem inflation. Is that likely to have a flow-on effect to Singapore with increasing mortgage rates? Traditionally, yes. I mean, when the Fed funds rates increase, it does have an impact. But remember, we're changing regime from a SIBOR rate, which is expectations-based, to that of a SORA package, which is basically negotiated rates and things like that. And really, that's based on an impact that I don't know how it will impact. We have to see, because in the past, even SOR was theoretical. And constructed. So SORA is a new regime that we have to wait and see. My suspicion is that it will be a delayed effect, and the effects will be muted, because everything will be negotiated. Yeah, but your guess is as good as mine. We just have to keep an eye on the numbers.
Okay. That's a question on SORA. Would you like to take that as well?
Yeah. YL asks, will SORA be more beneficial to homeowner or worse? Well, it depends on what you're looking at. Okay, so let me give you an example. A client of mine in the past, wanted to talk to me about floating rates. And essentially, SORA is a floating rate. It will change over time. And so I was telling him about floating rates and said that it's cheaper, right? And he was saying, he wants to go to fixed rates. And the reason why is simply this: he's willing to pay more as long as the rates are steady. It doesn't fluctuate, and this gives him a good amount of rest. So my guess is that for a lot of people, right, that will be the case. So it really depends on you. Have to have the conversation first. But for some of our clients, certainly SORA makes a lot of sense. Why? Because I think that personally, in my own opinion, in the short to medium term, maybe the next few years, I don't expect rates to fluctuate that wildly. I think that's beneficial, but that's pertaining to my own risk profile and expectations.
Right.
Yeah.
Well, there's a question by Richard on how do we see price trending between 99-year leasehold and freehold in the next 3 to 5 years. Right. I think if you look at pricing, there is a particular theory that freehold properties are priced at least 10% premium over leasehold properties.
Right.
But that is not a truism. Over the years and over all locations, we've seen freehold properties actually sold and transacted at a higher price than leasehold property being transacted at a higher price than freehold property. And again, I think it is dependent on location, right? The surrounding amenities, the attributes, whether the property is in closer proximity to MRT, walking distance versus driving distances, and whether the development is an integrated development, or it is more a standalone residential property. Yeah, so it is not just related to tenure per se, but many of these other attributes will have to be taken into consideration when we look at property prices.
I think the integrated developments are very interesting. We didn't cover very much about this. Maybe you want to talk about 2 minutes or 1 minute.
Yeah, sure. The integrated developments means that, the residential development is part of commercial development, whether office, and usually there's also a shopping mall connected to it. And the entire space is further linked to an MRT station. So these developments could sit on top of the MRT station, or they could be linked to an overground MRT station.
We see quite a few of those already coming up.
That's right. And these developments are popular in a sense. In fact, this was part of our consumer sentiment study in the second half of last year, that there is a preference for homeowners to look at properties which are near amenities, near F&B outlets, near the mall, so that it could facilitate ease of buying, their daily groceries and so on. And these properties are also the hot favorites for people who are looking at renting properties, because then they can commute, in the fastest possible time with the MRT, and if they work, in the office building that is part of the integrated development, wow, then that's really saving a lot of time.
The circuit breaker really highlighted the benefits of that near F&B outlets and stuff like that. You can walk to buy and eat at home or shop within walking distance. TK, this is for you, I think. Many of the transactions and keep it coming, okay? Don't be shy with the questions. Many of the transactions are condos. Do you see the same upward trajectory hold for landed property given the current COVID situation? Will landed prices be impacted?
Yeah, I think we can take a cue from last quarter's landed prices, was rallying strong at 5.6%.
That's right.
All right, on a quarter-on-quarter basis. And, landed properties are usually sought after because, number one, there is a finite stock or inventory of landed properties. We've also seen well-heeled individuals buying good class bungalows in the previous months, right? And this phenomena of landed being finite and at the same time sought after both by entry level and well-heeled individuals is something that I think will continue into the future. So unless we are able to build more landed properties and add on to the inventory, if not, then I think that the limited supply says it all. High demand, limited supply.
I mean, land is land, right? Land is land. There's a question from Daniel. Daniel talks about MOP effect. You mentioned that you think that the demand for new properties will taper over the next few years, right? But he's wondering, right, will it continue to support prices in the next 3 to 5 years? Very definite in terms of timeline that he's mentioning.
Yeah, so first of all, earlier in our conversation, I did mention that last year and this year, we see an unprecedented number of MOPs, which I described the MOP effect as being related to why we are seeing both the HDB resale market as well as the private residential market being vibrant over the last 4 quarters.
Right.
It provided a self-feeding ecosystem.
Right.
Then I mentioned that moving forward, because of the BTO supply in the preceding years, right, this is going to be tapered.
Right.
Yeah, we are not going to see 25,000 MOPs every year. Yeah. However, that said, HDB resale flats which are fairly recent, meaning you have 5 to 10 years, right?
Yeah.
Will be quite sought after because it means that you give the next HDB lessee who buys it quite a long lease,
right,
of say 90 years, right?
I think, I just want to piggyback on that. One of the questions asked about cash over valuation. So the comment here was that by Joyce says about, seems like COV recently is higher than before. That is what you're alluding to, that the demand for those with newer MOP properties tend to have higher COVs. That's implied by what you say.
Yeah, that's right. And also it varies location to location. So
right,
depending on which districts you are buying from, for example, Punggol is one of the all-time favorites.
Because of the tech play, right?
Yeah. Because yes, you are right. Because it's going to be the Silicon Valley of Singapore.
Yeah, Punggol.
Yeah, and then of course the all-time favorite like Queenstown.
Yeah.
Bishan. Yeah, these are the typically sought after locations, and also because like I said, the MOP flats tend to be also the bigger types, right? And I mentioned to date as of April this year, we have seen 74 $1 million flats. I mean, them are so higher than 1 million, a tad higher, but we have seen 74 $1 million.
Yeah. Amazing, right? Yeah.
That's amazing. And the whole of last year was 82. So it looks like this year, this record of $1 million flats is going to be exceeded. Yeah. Because we are only just crossing the first quarter of this year into the second quarter.
Okay. Yeah, actually, right now, I think there's some question about circuit breaker.
I'm not sure we can answer those questions.
Yeah, I
hope that it doesn't happen, like many of you out there.
Dion talks about second circuit breaker. We really don't know.
Yeah. But I just want to caution against fear.
Yeah.
On one hand, we should exercise caution, and that's where we observe the stricter safe distancing measures or safe management practices that have been put in place. But the last thing is to be overwhelmed by fear. Yeah, because fear cripples.
Yeah, it does.
And I think it's important also for us to take an objective view of the real estate market nonetheless. All right.
Yeah.
And if you are not able to, for example, to physically view a property, right? Your property agents will be able to help you with virtual tours and videos that will enable you to have an idea of what it is until such time the per household, per day visits.
Yeah. I think one of the questions that we get asked that I read earlier as one of the questions, and I want to take opportunity to jump in. Is this a good time to buy property? Should we wait? You want to address it? Because I will address it in my own way after this. After
you take a first step at it, man, brother.
Don't arrow me like that. So essentially, I get asked that question a lot of times. No matter how good or how bad, right? People always ask me, is this a good time to buy property? It's always a good time. And I say that consistently. Over the years that I've been in banking and all these things, people ask me, when is a good time? I'll say this is the best time. Why? Because it's not dependent on the market. It's dependent on the deal that you're looking at. If the property A appeals to you, B suits your needs, C, in terms of affordability matches to what you need, go for it, right? It's all in the negotiation and things like that. When the market is good, you'll find great deals. When the market is bad, you'll find great deals as well. But one needs to do the homework. The challenge I have is that a lot of clients want to buy properties, but they want people to tell them that it's a good deal. Unfortunately, you have to do the homework for it. Yeah.
Yeah, I think the way I look at it is when you are buying a property, which is a big ticket item, which requires you to invest your life savings, in many cases, right, into it, then it is important to be prudent.
Yeah.
So whether it's the best time to buy or not, it's not for the panelists to actually tell you, but more for you to consider, first of all, do you need an accommodation?
Yeah.
If you need an accommodation, then there are usually two options, right? You can buy or you can lease. And now there is a possibility of a third possible option in co-living space.
Yeah, that's right.
Yeah. So you could analyze along those lines whether it is time for you to save more until such a time when you feel more comfortable and more confident of buying. And of course, the second thing for you to consider is your finances. Don't just look at your CPF ordinary account, because your CPF ordinary account actually is very much dependent of the monthly contributions that come in from employer and employee.
That's right.
Yeah. And it is always prudent to take that perspective that where you can, and you can service your mortgage loan using cash in the event there is somewhat incapacitation of that funds.
That's right.
Yeah, then you will be able to move forward.
Yeah.
So that's the second thing to consider, because you need to plan for a rainy day, because nowadays when it rains, it pours. Yeah,
it storms, I think.
Yeah, and so that will be my my particular advice for all of us to take a more prudent approach when we buy properties, and right size your property expectation. Yeah, before before we just hop on the upgrading
Yeah.
It's important to right size our property expectation, so you don't have to buy a 5-room flat if a 4-room flat just does as well, or even a 3-room flat does as well. Yeah.
I think I will piggyback on that question by Daniel's cheeky question. Is there a bad time to buy a property? The answer is yes. The reason why is that when we talk to clients, right, a lot of people look at buying property based on the current position. So they will buy a property, let's say husband and wife, they say, okay, I want to buy a property, then they max out their earnings ability. And they say, okay, I want to buy this so that I can make money and things like that. But a lot of the times they fail to consider possible changes. So what are the possible changes? I've seen a case where husband and wife actually had plans to have the wife stop working after a few years. And what they did was they bought a huge property, right? And planning to live in it. But subsequently, when the wife stopped work, they cannot refinance. They got stuck. So they had to sell the property. And that really changed the whole situation. So future plans are a very big part of when you make decisions. You need to right size, you need to work in the numbers and say what makes sense. Unfortunately, a lot of times people look at loans or look at properties in terms of interest rates, how long the loan and things like that, but they fail to consider the fact that if the husband says, I want to start my business, if your business works very well, within 5-10 years, you make money, fantastic, right? But in a short term, chances are income will drop. So that will impact your quality of life, your decisions, and it may be a bad purchase. Bad purchase in the sense that you may be overcommitting to a property in view of your plan. So, it could be a bad time sometimes if you don't plan properly.
Yeah.
Yeah.
Yeah, I think timing is an issue that is also personal.
Yeah.
Yeah, because all of us are in different stations in life and different financial competencies.
Yeah.
So it's good to really consider that. I would suggest that you can seek advice from your friendly financial advisor, all right? And that could be PGF. Yeah. You could also check with your agent partner, right? Your trusted agent partner, whom you have bought properties from, or whom you are going to buy a property from, to really right size your property expectation and what is a good buy for the long term. Because if you are owner occupier, or you are investor, at the end of the day, you are also looking forward to the possibility of capital appreciation.
Right.
That's how you can also upgrade into the future. Yeah.
We actually have a lot of questions, TK, about timing the market. If I were to summarize and looking at it, if this is a good time to buy, should I invest in something, should I buy an investment property for rental purposes? And the question about timing the market, I think we can address these questions as a whole. If you ask us specifically, will there be cooling measures? We don't know. We don't have we can only guess, and that's our opinion only. But I think what's your view on timing the market about going in now to buy things and buy?
Yeah, it's always very difficult to time the market.
Yeah.
You can never figure out when it's going to be the bottom. You can also never quite figure out when prices is going to hit a snag as it spiral upwards, right?
Yeah.
But you can make a decision, all right, as to your personal need for an accommodation, all right. And if you are investing, of course, then you have to decide whether the current price increase works out for you in terms of your returns in the next 5 years. I say the next 5 years because the next 3 years you have seller stamp duty, right?
Yeah.
And I don't think any investor would want to consider selling in the next 3 years immediately after purchase, because that's the seller stamp duty. And that's also the government's way of snipping speculation, flipping properties. So if you can sell only in the 4th year or the 5th year, then you have to take that time horizon in terms of your investment plans.
Yeah.
Yeah, and we all know by real estate convention that property is actually an illiquid asset. It means it's not easily convertible to cash. It takes usually 3 months before you can offload the property. All right. And meanwhile, when you own a property, you have to maintain the property, whether it's landed or whether it's a strata title, private residential property, or even HDB. There are conservancy charges to be paid as well.
Yeah.
So, and property taxes. So if you take that long-term horizon, the cost of maintaining a property in mind, then you will probably be able to make a better decision. Of course, it is very enticing now to borrow at low interest rates. But we all know, like I said earlier, or we said earlier, that interest rates will start climbing, be it 2023 or 2024. And therefore, there's a need for us to take a longer term horizon.
Yeah, I think, if I were to add on to that, everything has a price. If you look at it, if a property, when you check with the valuers, is the bank's value at 1 million, right? And somehow at arm's length means the transaction is from somebody you don't know. It's not a friendly brother price, or you go out and officially you can get it for 800,000. Right, and really it is available in the market, right? That's a buying opportunity, if you ask me.
Yes.
Because it's in the price, right? Yes. If, however, you look at it, you say it's 1.2 million, right? Then you must ask yourself, do I love the property that much? End of the day, it comes down to questions like that. When you look at the deals, it's like you go Pasar Malam, when you go to the night market and you negotiate with the guy. The fellow, the item is worth, the guy quotes you $50, but you think it's worth 40, right? So it's the same thing, just for bigger value item. I mean, if I were to reduce it to the simple, this is what we look at every day when we work, right? And don't just buy because of cheap interest rate and all that. I think it must make sense for your longer term plan and things like that.
Yeah. Perhaps we just take one question on rental, all right?
Yeah.
And then we may have to then defer the rest of the questions. We will either answer on block if they have a similar theme, run through all of them, and later at the Ask Guru forum.
Yes.
Yeah, so there is a comment and a question about rentals moving up, right? Due to border closures and could that be behind the increase in high rent or rather high rental prices and therefore the demand for resale properties? Yeah. So for me, when I look at the rental market, actually it was relatively precarious during the circuit breaker period. Because foreigners were actually returning to their home country, and therefore leaving some of the properties actually vacant. And it was also difficult because when there's job loss, for some of these to continue with their existing leases. So what landlords actually did was renegotiated with the tenants at that point in time during the circuit breaker period and quite immediately after for the tenants to continue to stay. And we know at that point in time there were rental discounts, right, given to the tenants for renewing. Right? So it's a win-win thing because if I'm a landlord, I continue to secure my rental income. Albeit at a lower rate. For the tenant who is, facing a financial situation, right, he or she will get it at a lower rent.
Right.
Then we have the delays in both new condo completions and BTOs. So if I'm in the dire need for accommodation, and my flat's completion or my new condo completion is going to be delayed, then I have to find alternative accommodation. And that will mean renting.
Right.
And therefore, after a while, the demand for lease went up. And as a result of that, the renters also spiked. So it is not particularly related to border closures per se. Because you have already a domestic market for rental. And so that's probably my comment. I don't know whether you have anything else to add.
No, I think that's a fair point because I found my friends, right? So two instances that I can share with you. First one is somebody who's in the construction business. He actually shared with me right now. Because of the labor shortages because our friends from across the border couldn't come, now they have to pick and choose, right, which projects to do.
Right.
And there are additional costs of labor costs for all these things and rescheduling of construction. That's the first point. Second thing is, again, my friends were waiting to move into a new place after they sold. They found they had to rent so not so much that, but the overall impact on the construction industry and things like that. I think that's really very, very important to understand.
Yeah, that's right. And even for permanent residents, newly minted permanent residents, they can't lease HDB flats.
Right.
They can't sublet. And so they have to go to the private residential market as well. So that's some of these that we have to take note, especially during this period of pandemic.
I think we are almost at our time, but one of the things that we want to highlight is that, on PropertyGuru website, there is something called Ask Guru. Please go to Ask Guru and drop your questions. You don't have to wait for a webinar like this to answer any questions or burning questions you may have. Go to the Ask Guru and drop your questions there. And we have a team of people actually answering those questions for you. Whatever that we can do, to help you answer your questions. I think it's really important to have an avenue, and I'm very blessed to be seated next to this expert in the market. TK is a well-known veteran in the property market, and I've learned a lot from him. Yeah.
I'm seated next to the financial wizard. But anyway, thank you so much for tuning in. I hope that the hour that just passed has somewhat been beneficial and enriching for you. Like I said, keep your questions coming in at the Ask Guru platform, and we should be able to reach out to you with our responses in due course. All right. Thank you so much, and hope to see you again in our next webinar.
Thank you.
Thank you, and a good afternoon to you.
Good afternoon.